Hello, welcome to the Expat Property Portfolio podcast. I'm your host, Callum Williamson, and today we have a very special guest on the show, Lucian Cook, head of Savills Residential Research. He's been in property over 30 years, with Savills over 30 years, and actually Lucian and Savills are the people we go to get a lot of our research. A lot of their 5-year predictions show where they think growth is going in different regions of the UK. Lucian also has a monthly newsletter, which is again, interesting, insightful. And one of the foundations for buying property or investing in property, as you'll know from our book and listening to our content, is your research and your planning. And so listening to people like Lucian and reading his content is very useful. I hope you enjoy, and I hope you found it as insightful as I did. Why don't we start with the basics? Tell us a little bit about, your background in property, and, how you got into working with Savills.
So I suppose I've been on quite an interesting journey in terms of getting into property. So my father was a farmer, and my mother was a domestic science teacher. So there wasn't necessarily the grounding for this sort of grand career within property research. But I sort of worked out I was never going to go and be a farmer. I wanted to do something that my father would sort of understand, and property seemed like the next best thing. That took me to university, and I read land economy. I was very lucky in that I managed to read land economy at Cambridge, and that sort of really sparked this desire for property. And since then, I've been at Savills for almost an eternity. It's been in excess of 30 years. I've had 2 careers within the business. The last 18 or so of those years, I've been in residential property research. And I suppose the joy of that is that it's always changed, right? There's always been something interesting to talk about, whether it's changes in the market, whether it's changes in the background of the economy, whether it's policy changes, just whether it's the way that we perceive and use changes. Over that period, there has almost never been a dull moment. I think it would be unfair to say that there haven't been the occasional one, but there's almost never been a dull moment.
I think that's it. If you read the headlines when it comes to property, it's always very sort of one extreme or the other. And there's never property markets are just going steady. You never have that. So, I think I was looking at your LinkedIn, and you've been at Savills, as you say, over 30 years, which is pretty cool. So I guess for those that don't know, what does Savills do? Can you give us a little bit of a sort of insight?
Savills are PLC. We're a property advisory group. We do everything across the property spectrum, in essence. So everything from the residential property space through from planning and development to residential investments to sales to lettings. But then that also spans across the commercial property and indeed the rural property spheres. So it is that quite diverse property advisory business, very strong in the UK, very strong through Asia as well.
Sorry to interrupt, but if you're enjoying this piece of content and would like to find out more about buying property and our key 10 steps to doing so, then pop your details in the link below somewhere and grab a copy of our book, 10 Steps to 10K, the Expat Property Playbook. Enjoy. It's really exciting having you on the podcast, because I think I mentioned when we were sort of doing the pre-podcast call last week that we actually get a lot of our research, from Savills and from yourself. So it's good to have you on, and I'm excited to sort of pick your brains, and hopefully our listeners will enjoy it as well. So why don't we get into some not technical questions, but some interesting questions. Last week, or it may be the week before when this goes out, the Bank of England voted rates down again. What sort of impact do you see that having on the market in, let's just say, the short term as a start?
Yeah, so I still think, despite those cuts in interest rates that we have seen and the expectation that we've got more to come, which are crucially important for the medium-term outlook for the property market in the UK, the short-term outlook is still a little bit constrained by some of the sentiment that we've got within the market. So clearly some economic challenges within the UK. The Chancellor within the UK faces some really quite tough decisions around public spending and taxation when they get to the next budget. Clearly, they've already had one go at that, but they're probably going to have a no-go. And I think that's sort of holding back buyer sentiment to a degree. So we look at lots and lots of ranges of measures. And one of the ones that we do is we look at the RICS residential market survey. It isn't necessarily the most sophisticated survey in the world, but it's got an amazing track record in terms of saying what's going to happen next. And that's telling us that new buyer inquiries in the residential property market are still contracting. Now, that will change, because every time you get an interest rate cut, that increases the buying power of buyers, but it also slightly widens the pool of buyers. And that's important, whether it be first-time buyers, whether it be home movers, or indeed whether it be investors. And of course, for the investment market, given the way that UK tax system is structured, every interest rate cut just opens up a bit more capacity for borrowing and a bit more capacity for activity within that market, albeit, I don't think it's quite going to get back to where it was, because some of the regulatory changes that we face, and
Yeah.
indeed a bit more taxation up front.
All right. And so where do you see, because there's been quite a lot of talk, I guess, over the past 12 months of rates coming down. And, we thought it was going to happen quite quickly. Then it sort of turned out it was going to be a bit slower. And now sort of off the back of the Trump tariffs, I think I read your article that was talking, saying a week is a long time in property. I think off the back of the Trump tariffs now, we're sort of expecting that to happen a little bit quicker again. So what are your personal view and Savills' view on sort of cuts for the rest of the year?
Yeah, so I mean, I would say 2 to 3 further rate cuts this year, probably a bit more weighted to the three than the two now. So what's happened with Trump and tariffs is really interesting. So I think in the first instance, it has sort of compounded some of those issues around buyer sentiment. And that means there's this sort of bit of weakness in the market, which actually for investors probably opens up a bit of a buying opportunity. But
Yeah.
it also means that when you have these rate cuts coming through, it provides a slightly better platform for the recovery when it comes. And there's some other stuff that's going on top of those interest rate cuts, which mean they're even more important. So the Bank of England, this is a bit geeky, but I love it. It's
Go for it.
what gets me on the 6:47 out of Winchester into London every morning. So there's been some other changes around mortgage regulation for people who are buying their main house. And that has basically eased the affordability tests that the banks
Yeah.
have to put the borrowers through. And I think it's that, combined with the prospect of these interest rate cuts, which is beginning to open up a bit more capacity for medium-term house price growth. Because it's that mortgage regulation which sort of held borrowers back. So there was a
Yeah.
period before we had the recent increase in interest rates where people were comfortable borrowing more than the banks were able to lend them.
Yeah.
And then you had this period when interest rents went up, when they just said, actually, hang on, there's only so much we're prepared to borrow, there's only so much we can afford. And then as
Yeah.
the interest rates come off, it opens up capacity, but you don't have the same break on the level of lending that you're going to get from the Bank of England. So, I mean, it's a really interesting time in terms of how policy, whether it's government policy or whether it's regulatory policy, is interacting with that economic outlook. And I would say probably opens up some short-term buying opportunities, and it probably means that it underpins the medium-term outlook for prices at a time when in the private rented sector, you're sort of saying you're going to have this continual embedded undersupply of homes available to rent.
That's good knowledge. Thank you. So what does that new stress testing look like then? Does it just mean they've brought down the sort of the stress test level from X% to X%, or what does that mean?
So to put it in context, at the moment, four major lenders have said that they've relaxed their stress tests, and they're big lenders within the UK. Santander were first out of the blocks. They were followed by Lloyds Banking Group, including Halifax, and you've also had NatWest and HSBC follow their rules. Now,
Okay.
previously, those lenders had to test at what we refer to as the standard variable rate, and the standard variable rate was high for those banks. It was sort of 6.75 to 7.25%. So stress testing
Um,
off that with a bit extra that's quite a high hurdle.
yeah.
What the Bank of England have said is actually, if people are going to offer you another mortgage at a lower rate, and those mortgages are available within your market, then use that lower rate to do your affordability testing off with a bit of a margin above that. There's various numbers that are out there, but for first time buyers, the broad range from what the banks have told us is it means that their maximum borrowing capacity can go up by circa 12 to 35,000, seems to be the numbers. Now, in the context of first time buyer house prices, that's quite a big number, right? And
Yeah.
and there's two things that can happen. One, it either means that people can borrow at higher loan to values, which brings more people into the market, or two, it means that house prices go up on the back of that. The reality, of course, is going to be a mix between the two. I mean, it's going to be
Yeah.
really interesting to see how that plays out, but it is going to be a bit more activity in the market, bit more upward pressure on house prices as a result. But for me, it's slightly gone under the radar. But that's, for me, that is a very significant change. And the fact that you've got those four big lenders who are already relaxing it and they've made a bit of a splash about it is interesting.
Yeah, and that would maybe sort of suggest that others will start following. If they want to be competitive, then they'll have to sort of replicate what they're doing.
And it is. I mean, what's interesting, it is a very competitive mortgage market, right? So
Yeah,
even those expectations of further rate cuts have been very quickly priced into the mortgage markets. And I suppose one of the things that's changed over the 18 years that I've been looking at the property market is that mortgage markets, because data is that much more freely available, because we sort of live in this age of real-time data, it means that the mortgage companies will monitor their share of the market. They will respond very quickly in terms of adjusting their rates to make sure that they're filling their loan books, and that means that
yeah,
when there's rate cuts on the horizon, they're pretty quick to price them in. So you've seen for home buyers, then you've seen sort of 5-year fixed rates now start to come in at less than 4%.
wow.
I don't think there's a tipping point when the market suddenly kicks on from that, but it does mean progressively as those rates come down, you start to open up that pool of buyers, gives you a bit more impetus into the market each time.
And I think that's a good point. I mean, the mortgage market is so competitive. There's so many lenders out there that actually they've got to be competitive if they want to get the business right. Yeah, one of the things you mentioned earlier, we were talking about research, and this is something I've always wondered is where do when you're doing your 5 year, now to 2029 predictions for the regions, the Northwest, I think you've got at 29%, the West Midlands, 26.4%. Where do you get these figures from? And you mentioned Rick's, but, have you got a team of people locked up in a warehouse somewhere sort of crunching numbers, or where do you get it all from?
Well, I've got the team of people, but they're not locked up in a warehouse, right? So we allow them all in head office.
Good.
I've got a couple up in Scotland, and I've got a couple dotted through the country, but the bulk of the team sit within London, within head office. And I think to run a research department, that's pretty important. You
Yeah,
can't run a research department in an ivory tower. You've got to be, the advantage of working at somewhere like Savills is you have the data available and you have the agents available who are living and breathing the market.
yeah,
And the
okay.
joy with research is you just bring that stuff together, and that sort of helps us do our forecast. But when it comes to the numerical stuff, then we've got a slightly smaller team of about 5 of us. Who really focus hard in on our house price and our rental forecasts and our market activity forecasts. In essence, we run an affordability model, and that looks at where mortgage payments will be as a percentage of income, both for the people who are out there actually borrowing and how the banks will look at them on this stress tested basis. And to
Yeah,
do that, we look at where we are now, we look at where that sits historically, we look at where mortgage rates are, where we think mortgage rates might go to on the back of the interest rate cuts, and then we feed in things like projected levels of income growth to work out how much capacity there is for house price growth. And we're currently across the UK, I think somewhere around 23% average. That is not atypical for a 5-year period in the market. It reflects the fact that we came into this with affordability quite stretched, that affordability eases, and the thing should sort of normalize over that 5-year period. When it comes to how we split it up between the regions, I am a great believer there in housing market cycles. And
yeah,
essentially, we would divide the market up into markets that lead in a housing market cycle and those that lag in a housing market cycle. So typically, London and the Southeast lead at the beginning of a housing market cycle. They deliver the strongest house price growth in the first 5 years of a housing market cycle. Then they sort of use up their capacity for house price growth, and then it tends to be the markets of the Midlands and the North that follow. They tend to be the stronger performers in the second half of the housing market cycle because they've got more capacity left for house price growth. And if you were to sort of pin me down now and say, where do we sit? I would say we're about halfway through the second half of that cycle. So
yeah.
we've already seen London take a bit of a back seat in terms of price growth for the last 5 to 7 years. We've started to see the Northwest lead within that period, but I still think there's some way to go. Now, clearly within those markets, there's parts of the market that have performed more strongly than others. So lumping the
Yeah.
whole of the Northwest is tricky. We know that's primarily been led by Manchester, and we know that that really has been led by the fact that Manchester's economy and employment base has changed quite a lot over the period of the last decade. But that's broadly how we do it. And I've got, it's a shame that I can't show you the charts, but as a researcher, you have a couple of favorites, right?
Yeah.
And some of my favorites are the simplest. So one of them is just average London and Northwest and Southeast house price relative to the UK average. And you just
Okay.
watch that change through the cycles, and that broadly tells you where you are and where the capacity sits.
Well, maybe if we do another podcast, we can get some of those up on the screen. But I guess two points. It's an important point actually. You've got your regional growth predictions, but you've got to bear in mind that some places will do better and some places will do worse within those. You talk about the housing market cycle. What sort of time frame is that? Because I remember reading a book by the fella that predicted when all these crashes would come over the years, Fred something, I think, the 18-year housing
Yeah.
market cycle. So is it an 18-year cycle, or do you have your own sort of time frame for the cycle?
Do you know what? Somebody, funny enough, I write a client email that goes out once a month, which sort of summarizes where we are in the market. And I had an email from somebody whose son was about to buy a property in the UK in London, and they asked me, "Do you subscribe to an 18.5-year housing market cycle?"
18.5.
Right? And it just doesn't work like that, because generally the housing market gets disrupted by black swan events more than anything else,
COVID.
right?
Yeah.
And if you can tell me that black swan events occur once every 18.6 years, then you're probably more Nostradamus than you are property market researcher,
Yeah.
right?
Yeah.
So yes, there are cycles, but those cycles vary in length. One of the other great myths we have in the UK housing market is that prices double every 10 years,
Yeah. I
right?
saw that the other
Right?
day.
People love
Yeah.
that, but it doesn't happen regularly. It's
Yeah.
so for me, you've got to go back to the fundamentals. Yes, I believe in cycles. Yes, I believe that you have periods where the market is in recovery. It takes much longer for sentiment to catch up with the economic fundamentals of affordability, right? And I believe that, and I do believe that you get periods of over exuberance where the market just gets a bit too hot because everybody gets carried away. One of the things I would argue is that those periods of exuberance have been reined in by some of the mortgage regulation that we've seen. So when the Bank of England first introduced that mortgage regulation, it was really strict. And we all sat there going, blimey, that's pretty draconian. Like, there's no way rates are going to go up overnight by 3% above the benchmark. And then, hey presto, we get war in Ukraine, we get a bout of Trussonomics, you get that sharp burst in inflation sort of coming out post COVID, and it did exactly that. And do you know what?
Yeah.
The mortgage regulation worked like a dream in those circumstances, because house prices fell back by about 5%. So not a dramatic fall in the context of their growth track record. And it had insulated the market. It meant that you
Yeah.
didn't, like you did in, say, like the 1990s, when you had a lot of forced sellers because they just couldn't afford their mortgage. A lot of
Yeah.
people found it uncomfortable. Their household finances were stretched, but because the regulation had stopped them taking on too much debt, they weren't in a position where they simply couldn't afford it. So you didn't get
Yeah.
people handing back their keys. So I think mortgage regulation has been a really interesting facet. And I know it's technical, and I know it's a bit geeky, but have a look at it. It's good stuff.
Yeah, I think it's important to understand. So on the cycle, then I guess before we move on, so you would look at what London is doing, say over if London's growing for 4 or 5 years and then it stops growing or slows down, you
Yeah.
would say, okay, now we're moving into the second part of that cycle where the regions will take over.
Yeah, absolutely. I think one of the things that slightly sold us a dummy during the last half of the last cycle is that London kicked on more than any of us expected for a longer
Yeah,
period. So when you look at that relationship between average UK and average London prices, there was a point where we thought, all right, now it's done now. Right, but it kicked on more than we had seen in any previous cycle. Now that might just have been because London recalibrated to the rest of the UK, but it does mean that London has taken a bit of a back seat to some of these other some of these other regional cities in terms of price growth. And it also means like the investor focus has changed,
Yeah.
because you get to that point in the cycle where you've had the very strong house price growth in whatever market. That's brought your gross yield down, right?
Yeah.
And your capacity for house price growth is a bit less. And then the investors will shift their focus to the areas where there's more capacity for house price growth, where the initial yields are higher. And I'd say classically, that's what you've seen over the period since the mid to late 2010s, a much greater focus on some of those other regional cities from an investor perspective.
Yeah, for sure. And you can see it. I mean, we've been operating in, you say Birmingham, for example. I remember 10 years ago when I went and did a sort of a tour of a new development in the jewellery quarter there. I think
Yeah.
one beds were selling at £120,000 and twos at 160. I mean, and if you go to the jewellery quarter now and try and buy a one bed, you're probably paying best part of 300,000,
Yeah.
270. So
And that's a great case study, isn't it? Right? Because I can sit there and I can do all of the numbers and the great property research. But the other bit that you've got to do when you get into the investment is look at the fundamentals of the area and understand
yeah,
what the capacity is for that area to, particularly when you're looking at new build investment property, what are the regeneration prospects for that area as well? Right. And
yeah,
that's always going to be a bit harder to do from a research perspective. It can help. I think that's where you just need the property professional advice, right?
yeah.
That's the bit. And I think that's one of the things that makes property so interesting, right?
That's it with property. You sort of sit down to talk to someone about property, and there's so many. If you're speaking to someone about X product, a bit of software or something, it's pretty straightforward, right? But with property, you need to know regions, different types of property, mortgage markets, what the impact of what's going on in America is going to have, all tenant types, all of these different things you need to have knowledge on. So it's fun, but and it can be daunting if you're new to it. So it's an interesting market, Birmingham, I think. Okay, I've got some questions for you around what do you, whilst we're on the subject of sort of buy to let and the investment perspective, from a personal perspective, what do you think makes a good buy to let?
I think it depends what you're after, right? And I think the first thing to do
Yeah,
is to work out exactly what you want for your investment. If you are looking for a straight income yield, then you are typically going to focus on smaller properties in less expensive markets, and you will find that your income yield there will be higher. Often those properties will have a higher management requirement, however, right? So you've then got to factor that in. If you're after capital growth, then you want a bit more of a balance between the returns, then you're probably going to look at some slightly larger properties, particularly given that the people who are carrying mortgage debt at the moment are very, very yield conscious, right? Because unless they've put it in a corporate structure, they've got quite a high tax exposure
yeah,
on that property. They tend to say, right, the income yield is absolutely the paramount thing. I've got to make sure that this investment washes its face after mortgage and provides me with a margin on that. That tends to push me to higher yielding markets, and that leaves a bit of space, I think, for other properties where you haven't perhaps got quite the same yield, although yields are looking pretty good generally at the moment across the market. But I think I can probably get a bit more capital growth, because I think I can also pick up a bit of demand when I come to exit from people, either affluent first time buyers or people who are trading up the market. So I think you've kind of got to understand it. In other respects, what do you want? Well, look, increasingly you're going to be looking at more energy efficient stock, because at some point the government is going to regulate and put in minimum energy efficiency standards. And it could be at some point that your lenders are are more comfortable in lending to you on better terms where your stock has got a higher energy efficiency rating. And I also think you want to look for those which have got lesser management requirements, right? You
yeah.
might buy something that you do up, it increases your yield. But if you do it up, you're future proofing that investment from having a high ongoing repairs responsibility as you go forward. So I think all of those things go into play. But the other thing is just making sure you've got your management platform right, because you've got an increasingly complicated regulatory backdrop, right? You need to be taking decent professional advice through your ownership of that property to make sure that you can navigate this regulation in the best way possible.
Yeah, I mean, I think It's spoken like a professional, which of course you are, but I think that's exactly, the answer to where is a good place to buy as well. What are your goals? Your goals are so important. And we've got, this is a shameless plug of our ebook. The first 5 steps are goal setting and planning, because I think that's the hardest thing to do. And once you've got that clear, the rest becomes easy, right? Because you know the locations, the types of property, all of that sort of stuff. Okay, let's talk a little bit about the Renters Reform Bill then, and what that means for landlords and overseas landlords.
Yeah, so I mean, the Renters Reform Bill was always coming, right? So it is just changing the regulatory backdrop. It is a reflection of the fact that we've had very significant growth in the private rented sector since 2000. And the demands on that private rented sector have changed very dramatically, particularly with the advent of more families renting in the private rented sector and people staying in the private rented sector for longer life stages. Renters Reform Bill essentially gives more security of tenure to tenants, and it removes the ability of landlords essentially to recover possession by waiting for the end of the tenancy and just serving 2 months notice. But there's some important stuff in there, and this really protects the liquidity of the investment of the landlord. The landlord still has the ability to recover possession in the event that they want to sell, right? And that for me is the important, because that gives a private investor the exit route to make sure that they can maximize the value of their property at the point that they come to sell that property. It has become a bit more weighted in terms of the notice periods that you have to give, and it will mean that you need to take decent professional advice as you approach rent review. I think that's going to be one of the really important points that you do here, because you'll have a much more formal procedure for rent review. And I think to make sure that your rent proposal doesn't get referred up to tribunal where there could be some delay, you want to make sure that you've got your evidence absolutely right when you go for that. When you go for an increase, in rent. What will it do? I think one of the things it's doing already is it is. I'm going to use an agricultural phrase here. I don't know if people are going to understand this,
Let's try it.
but it's going to sort the wheat from the chaff, by which
Oh yeah.
it means you're going to get back to those investors who are committed in the sector. I think what you're seeing already is a change in the profile of landlords within the sector. It is one where it is become more weighted to larger, more professional landlords with more equity behind them and less requirement on mortgage debt. Because in essence, they are better able to diversify any property specific risks across their portfolio. They're also better placed, for example, to use economies of scale to address issues like, how do I get the energy efficiency of my property up to the required rating? So it's definitely sort of doing a bit of a shift. There was an expectation, I think, that there would be an exodus of landlords from the sector. It is very
Yeah.
difficult to find the evidence to prove that. You can see that it's restructuring, and you still got this fundamental undersupply of rental property, but it's actually quite difficult to pinpoint the evidence to say that there's been a huge loss of stock from the private rented sector. It's definitely made buyers more cautious, that's for sure, and it's changed the nature of those buyers. But I'm yet to be convinced that we've seen the exodus. That's because that I think that is much more anecdotal than it is backed up by hard data.
Yeah, and I think you're right. We're seeing it ourselves, a shift towards more being a professional landlord, using a company structure, having proper systems in place. The sort of accidental landlords, or the one or twos, are sort of disappearing. We're seeing anyway, with our clients from the market, it's the people that do it professionally with a proper team that sort of make a success out of it. Where do you see, or do you see the market changing? What sort of sectors or areas do you see becoming more prominent over the next 5, 10 years? Will it be more specific build to rent, where we've got a
Mm.
concierge, a gym, home working space, or will it be more of a shift to HMOs and people sharing because they can't afford a single dwelling? Where do you sort of see, if any, shifts in the market?
I think if you're a private investor, so let's look at the build to rent market to start with. Really interesting. You've got quite a lot of stock in the build to rent market, which is now reaching completion and hitting the market. The scale of that build to rent investment in the context of the country actually isn't enough to really shift the dynamics of the private rented sector, because it's a still despite the fact you've had lots of investments into it, it is still a relatively small part of the whole of the private rented sector. What it can do is distort local markets. Where you get a lot of it in one place, it will distort local markets, and it will change the requirements of tenants and what they expect from their landlords. And I think it's interesting, I think that there's a risk that you could get into an arms race around that. I think the next evolution of the private rented sector will be a much more diverse offering from that, moving down further into the mainstream, perhaps
Yeah.
with systems which give the tenants confidence that any management issues are going to be dealt with, but necessarily you're not going to see quite the same number of add-ons that you've
Yeah.
seen previously. But that evolution has slightly been put on hold in a higher interest rate environment, because it's been slightly more difficult for those big investors to make the maths work. It will come back, but that's one of the areas I think that requires interest rates to come off, and for the underlying economic environment to change a bit, for that to have, if you like, its next burst of growth. HMOs, I think they are going to increasingly become the domain of the specialist investor, just given
Okay.
the regulatory requirements about those. Definitely professional landlords able to keep up with the regulation, high management requirement, probably pretty yield hungry. But all of that said, I would say I still think there's quite a lot of opportunity within the sector. If you're a committed investor, I think such is the undersupply of private rented stock that actually if you've picked your market to suit your goals and you target that market, I still think there's going to be plenty of opportunity. I still think you will find fundamentally demand outstrips supply. And again, I go back to that RICS survey. It's a balance of opinion survey that looks at whether or not you've got more new buyer inquiries or more stock coming to the market. The rental element is about rental demand and new instructions coming from landlords. The gap between those two measures, with demand outstripping the amount of supply, has been pretty wide for a very long period now, and none of the readings are saying that that's particularly closing. So that's kind of interesting.
I think that's it, isn't it? We get asked a lot, is the UK still a good place to buy? Or should I be looking at Dubai or elsewhere? And I think basic supply and demand in the UK, we're not building enough. We've got an increasing population, so increasing demand and a low supply. I mean, fundamentally, what you need for prices or rents to go up are there in the market. So if people have listened to this and they found it insightful, which I'm sure they would have, where can they find, as we do, where can they find your research? Can they sign up to newsletters, listen to your podcast?
Yeah, absolutely. So the website's a pretty good place. In the first instance, if you get onto Savills' website, you can get into the insights and opinion section, and you can find the research section there. Do a bit of searching, and you will find, I would say, a plethora of research information and reports, which we're updating on a pretty regular basis. You have the ability there to subscribe to the research, and you should have the ability to subscribe to my monthly email. So I do a monthly email to a lot of Savills clients, which basically says, this is what's happening in the sector. These are the big things that you need to be aware of. This is the broad trend of how things are playing out. And occasionally, when I write that newsletter, I'm given license by our marketing department to spice it up occasionally. So my most successful and most read ever newsletter was where I managed to link every paragraph to a song by Taylor Swift when she was touring the UK. So it kind of just goes to show that you can do all the research in the world, but if you really want people to engage with it, you've got to do it with a little bit of personality. So I am waiting with bated breath for Oasis to start their tour, because that's gonna allow me to repeat the exercise with some sort of heavy Britpop references.
Surely people will love that. I mean, everyone's been waiting a very long time for the Oasis reunion, so I'll keep an eye out for that one. And we'll put a link to the sort of research section in the show notes and all of that sort of stuff, so people can get on that. I'm
Brilliant.
pretty happy with that.
Thank you. Hopefully
Thanks
that
very
works
much,
for you.
Lucian.
Great stuff.
Appreciate it. Thank you very
All
much.
right. See you soon. Bye-bye.
Cheers. Bye.